Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, January 25th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
Okay, well, we'll just go touch base real quickly on what happened last week because I think most people want to hear about, talk about yesterday. But the rate hike jitters last week sent the major averages sharply lower. As we saw a little spike in Treasury yields, they were back up to where they were in January of 2020. So we've retraced pretty much all of the cuts that taken it down to the zero level. The 10-year actually got up to 190 on Wednesday of last week. It was it closed at 176. We're seeing it tick it up a little bit yesterday and today, especially ahead of the FOMC meeting that started today and ends tomorrow. Then later on in the week, we got a bad jobs report. Then we had missed earnings from Goldman Sachs, I believe, on Tuesday or Wednesday. That took the financials down hard. And then Friday, we got another earnings report from Netflix, or Thursday night, I guess, it weighed on the market. Netflix was down something like almost 22%. That helped trigger a sell-off in the NASDAQ and also these big momentum stocks. I believe NASDAQ was down just 2 3/4% or so just on Friday alone. And I believe yesterday at one point we actually fell into, I think we might have been down 20% at one point yesterday, almost in a bear market. So as far as selling went across the board, every sector was red. The consumer discretionary, technology, and financials, they were all down more than 6% last week. They all broke through key support areas. Materials, communication services, and industrials also lagged. They're somewhere down around below their 100-day moving average, but they were able to somewhat hold some of the key support levels down around above the 200-day level, 200-day moving average. Now, yesterday they didn't do that, which we'll go into in a little bit. So as of Friday's close, the only index that we really kind of put weighting on was the Philadelphia Semiconductor Index, and that was the only one that was above it. I think it's 50-day moving average, but it was down 11.9% on the week. So it certainly wasn't a pocket of strength, but it had actually outperformed. But a 12% drop in a week is that's some heavy selling going on in that. Now we also had the dollar pull down a little bit. It was actually up and down last week. When the dollar is weak, we start to see the commodity index rise because they're traded in U.S. dollars. We actually had the CRB index, which is the commodity index, hit its highest mark since 2014 on, I believe, Wednesday or Thursday of last week. That backed off on Friday's a dollar firm going into this week because, of course, as rates go up, usually we'll see a little bit upward pressure on the U.S. dollar. We had crude oil prices also. They hit a 7-year high. They were flirting with $88 a barrel before backing off on Friday to below 85. Precious metals were also on the rise. Gold and silver looked strong. Part of that is also on the rising tensions between Russia and the U.S. over the Ukraine thing. On Wednesday alone, the Vectors Gold Miners ETF, GDX, was up more than 7%, and the Silver Miners ETF was actually up almost 8% on that day alone. So certainly you're getting a move into risk-off assets. Also some of besides the precious metals, you're seeing some of the other miners move higher too with the nickel and that type of thing. So at the end of the week, though, basically we had the NASDAQ had its worst weekly percentage loss since March of 2020 when we had the big sell-off. And then the Dow Jones and S&P 500 were down for a third consecutive week. And that was actually the fourth consecutive week for the NASDAQ to be down. I think the same with the Russell 2000. On a technical basis, I just mentioned that we saw a lot more deterioration. But the big averages broke through their key support levels. MACD, which kind of looks at the short-term trend, and also the longer-term trend MACD. They're all in bearish territory. They've crossed over, which signals that the trend is lower. Momentum, which was measured by the 14-day RSI, we saw that fall below 30 for most of the indexes. And if you've heard some of these talks before, in a bullish trend, you'd like to see that oscillator kind of or indicator stay above 40. I mean, maybe you dip down to 38 on a hard sell-off and it bounces up. But once it falls below 40 and stays there for a day or two, which is just done now, you're basically in a downtrend that's going to stick around for a little bit. A closer look, we had the energy and consumer staples and utilities, which we consider defensive sectors. They were still above their 50-day moving average at the close on Friday, but every other sector was below either its 100 or 200-day moving average. That indicates that the intermediate term trend on those sectors is also bearish. So it's not just, there's really no place to hide. With rising rates, utilities usually aren't, and REITs are usually aren't a place that you want to be piling a bunch of money in, but they are a little bit defensive. So I guess that's why you're seeing them not just completely sell off. So that's something to kind of watch. Just because they're outperforming here, I'm not sure I would be wanting to jump into, especially the utilities and consumer staples at this stage. We'll talk about maybe that a little bit later too. But anyway, so we had the Dow Jones and S&P down 6%, 7.5% respectively. The Dow Jones Transports was off about 9.5%. The small cap Russell 2000 at the close of Friday was off 17.6%. It's now in a bear market, and small cap stocks, when you start to see rates rise, they're going to get slammed a little bit more. Part of that is because you have the small businesses. As the rates start to tick up, it's going to be it's more expensive for them to borrow money for them to expand their business. So it kind of keeps a lever on their growth potential. So that's not a place where we want to go at this stage right now. At some point we're going to want to, because they've actually erased all of last year's gains, and they're back to where they were in 2020 at some point. Okay, so we had targets for the Dow Jones and the S&P 500. They were actually hit. On Friday's market letter, we had downside target of the Dow Jones was 33,850 to 34,000, somewhere in that target, and 4350 to 4375 for the S&P 500. We hit those and actually went a little bit below those. We'll see what happens today if they're going to stay above that. I'd hope they would. I think it's probably a place where maybe you start to nibble around if we can hold above that for a day or two here. We talk about negative divergence a lot. Internal market breadth that I follow, which includes like the NYSE and NASDAQ advanced decline lines. I consider those leading indicators of market direction. They both lost significant ground last week. I think the NYSE AD line lost something like 7,360 units. The NASDAQ AD line was off 9,800 units. So that just shows broad participation to the downside in all these stocks. We talked on how, I think it was the S&P 500 a couple of weeks ago. It hit a new high on actually January 4th. We hit a new high in the S&P 500 and NYSE. On the 4th, we hit a third and fourth, we hit a new high in the S&P 500. On both those days, the AD lines were negative. So that was we talked about at the time, those were unconfirmed new highs. The negative divergence was basically a red flag saying, this is not a healthy new high. It's something we wanted to be cautious around, and it probably we're going to see some kind of pullback in the market. Okay, well, Friday we're down. We had about 50 on the 50-day moving average. We only had about 31% of the stocks in the MarketEdge universe that were above that 50-day, and only about 37% of stocks were above the 200-day moving average. You don't see that very often. That's a very oversold market. Of course, you have the MarketEdge S&P short range oscillator. Jim Cramer was talking about that last night. We talked about it on Friday's letter. When that gets down around 6.5 to 7, that's usually a spot that you'll see institutional money come in. We got down below 7 yesterday afternoon. I don't know what it is today. We'll have to take a look at it, but that was a sign that you were going to get some institutions were going to go in. Of course, you can the SRO, you can buy that on the MarketEdge site. It's updated for you daily and gives you the overbought and oversold market conditions and when the institutions are normally going in. Other than that, on the plus side, we did have sentiment index moved up to a positive +4, and that's a sign that we're getting close to an extreme level on too much bearishness in the market. One of the things we looked at, the percentage of bullish investment advisors was down below 40. That's actually a bullish sign. We actually had the AAII, which is the American Association of Individual Investors. They were at their lowest reading since, I think that was the lowest they had been in that was a 16-month low in the bullish sentiment, and they were at a 16-month high on the bearish sentiment. So the retail investors they're pretty much almost at an extreme level right now. Probably after yesterday, it's going to be a lot worse. And even the institutions have gone from having 85.7% exposure to stocks the last week of December. At the end of last week, they were down to 56.7. So they're off. They're about 50% invested right now. That number may come down towards this week. I would expect it to come, but at the same side, we are getting down to levels where we may start to see the institutions and hedge funds start to look at indexes, at entry point levels, and so that's something to keep an eye on. We did actually see some on equity funds. We saw money pull out of the market for the first time last week in 5 weeks. We had a lot of money coming in, which is at the end of the year, which normally sends the market higher. As far as the industry group analysis goes on MarketEdge, we're getting down to where we're only having 10, 15 industry groups that are strong or improving. And again, those are going to be the metals, non-ferrous. You're going to see some of the commodities. You're also going to see the gold and silver miners that are strong right now as investors move into safer assets. And on our ETF categories, if you go into the ETF center last week, commodity-based metals were up 3%. The precious metals were up a couple percent, and the shorts were the biggest ETF movers last week. But it's a weak market. We had if you missed yesterday, you just looked at the final readings, you may have been shocked and learned that the market was down about 1,100 points, the Dow, early in the day, and then actually ended up with a positive number to close. You don't usually see that type of strong turnaround in the market, but we can talk about that maybe a little bit later. But as right now, we're still cautious on the market. We came out to a neutral position. We had been long most of last year, and at this stage, we're going to stay neutral on the market and expect a little bit more selling.
All right. So market technicians have been talking about a market pullback for the past few weeks, and I've heard several talking about a selling climax, capitulation bottom, and other terms. Is that what yesterday was? The market letter had some targets of 34,000 for the Dow Jones Industrial and 4350 to 4375 for the S&P 500, which were hit on Monday. Is it all clear to move back into the market, or do you recommend staying on the sidelines here?
Well, I'm going to. Yesterday, a lot of analysts who came on TV, they were saying this is a selling climax, this is a capitulation bottom, which are technical terms for that normally is a sign that you want to jump in. Now, there's certain things that have to happen before you can say that's what happened. You need to roll in. Number one is you need to see those type of sell-offs and turnarounds with big reversal in volume. You did have that yesterday. I mean, I would have liked to have seen it more because the day before Friday, although it was options expiration, we had 5.8 billion shares in the NYSE and 5.5 billion shares traded on the NASDAQ. However, that was options expiration, which you would expect to see a higher volume. But before that, we had about 4.6 and 5 5 billion or so on the NASDAQ. Okay, so we moved up to 6.9 on both the NYSE and the NASDAQ, which that was good, strong volume. So you were kind of getting close to the borderline where you could say that was it. Okay, we sold off. Everybody's throwing the baby out with the bathwater. We had to throw in the towel, and then the institutions jump in. That wasn't quite enough volume for me. I would like to see that closer to maybe 8 billion on the NYSE in volume before I would say that was the capitulation. We need to see that. Now, the second thing you wanted to see, and if I'm in Ohio right now, I'm not able. I didn't do the daily comment yesterday, but a second thing that you would like to do, you need to see follow through in the morning. You want to see the trend, which is the traders index, probably finish that day at maybe 0.64, maybe 0.50, something like that. That shows that the majority of there's still orders on the sidelines that haven't gotten executed yet. There's going to be more buying at the open. I thought, no, we didn't see that. In fact, the trend yesterday at the close was 0.94, which basically is a neutral position. So the buying that was telling you that the buying was may have been exhausted with that turnaround. The other thing that you want to see. Hold on a second, Will. I'm going to stop it there just for 1 second.
Yeah, cut this.
Okay. Where was I headed with this thing? Jesus. What was I going to say? Okay, I just finished. Okay, we just finished with the trend. Okay, so we didn't quite get that. We had the neutral position on the orders coming in at the close. And then you want to see at least one day, or maybe preferably even 2 days, where you come in the morning and you see the markets, the futures are already up, 150, another 200 points. You want to see that the market makers are bringing from the sidelines. Institutional investors they're lined up, they're ready to buy. They want to get stuff at the open because they anticipate the market going higher. And we didn't have that today, obviously. Overnight, the futures showed the Dow Jones was down about 300 points. That's not called follow through. That means more you had exhaustive buying yesterday's afternoon, which filtered out, kind of phased out towards the end, leaving you at the 0.94. Now, one sign that was good, you had the VIX, the volatility index, actually got up around 38, 39 yesterday, and if you heard me talk on these, generally I think when you get up above between 30 and 35, if you're not at a bottom, you're very close to a bottom. And 39 was as high as we got actually in March of 2020. So that was telling you that, people say this is probably, that's when they were probably thinking it's a climax, and that was actually a positive. Today we went down on the Dow about 33.6, something like that. Our target, as you mentioned, was 33,850 to 34,000. We got to that, and now we're 34,000 plus, and we're kind of going sideways in the Dow Jones here. So that bottom that we had picked out looks like it may be right around the place where we're going to start to see people start to put money to work. As far as the S&P 500 goes, we had the 4350. 4375. We're just below that right now, just a little bit. So, which means that's not too bad. We were at 4,700 where we put that target in. So we got pretty much what we thought we would find, where we'd find support, and that's a positive also. As far as today goes, unfortunately, you still have the AD lines that are they're showing more declining issues and advancing issues. In fact, the NYSE, we have 865 advancing stocks to 2,387 to the downside, and it's about 2.5 to 1 to the downside on the NASDAQ. New highs, new lows are they've contracted from what they were yesterday, which means you're not seeing big dips. And that's a plus. Yesterday, I think we had 1,755 new lows in the NASDAQ. That's about as low as you're going to get. I only had 18 new highs. On the NYSE, we had 7 new highs and almost 800 new lows. Today, we only have 118 new lows on the NYSE, so you're off the bottoms there. And with the NASDAQ, we only have 176, so that's, you're 1,600 stocks less making new lows. Now, normally I would say, and I do say, this is a point with this sell-off where you have basically gone almost into a bear market. I think you want to watch right here with the S&P 500. Let me see where we are on the 200-day moving average on that, on my chart here. If you want to pull up the S&P 500, Will, we can look at that. As you can see, we closed below that on Friday, and Monday you can see the tail on the candlestick coming down. Today we started out with the tail. We almost came back up even, and now we're starting to work our way lower again. There's a couple things on these charts that I want you to look at. The technicians will look at. Number one, if you look at the 14-day RSI, which is the indicator right below the volume there, in a bull market or bull trend, you're on any kind of sell-off. Normally, you're not going to see the 14-day RSI go below 40 and stay there. Yesterday, we were down in the 30s or high 20s, and that's a sign that the trend has gone. That's not a sell-off in a bull market. When you're down here, yesterday I think we were right now we're at 24 on the 14-day RSI on the S&P 500. That's not a pullback in a bull market. That's telling you that we're in a downtrend that may go sideways for a while here. It could even go lower, but we are very oversold. And again, we're kind of some of these support levels. Where if we finish right here around this 4,300, that pretty much is where we found support, as you can see on the chart there, back in October. That's where the sell-off went there. We bounced around there, and at that time, we actually did get down to around 30, 36, 37, and then we reversed. And when you come off of these 14-day RSI, it's still in the low 20s or 30s. You want for that to indicate that we've got back into a bull trend. You want to see that 14-day RSI go back above 65, which we did by the 1st of November. The 14-day RSI in the S&P 500 was back up over 70. So that was telling you, okay, that sell-off's over and we're back in. With this thing here, we could get a bounce back that goes back to say 50, 55. That's not telling you that we're in a reversal. That's telling you that may be a rebound in a downtrend market. So we want to watch for that. Now, as far as other things goes, to tell you this, it's a little bit too early to jump into the market here. Hey, tomorrow we still have the FOMC meeting announcement, and obviously, especially with the last couple of days, you're not going to have Chairman Powell come out here and say, "By God, we've got to, we need to hike these rates 5, 6 times here to get control of this inflation." They keep their eye on the market. They're not supposed to, but they do keep their eye on the market. And he's not about to ruffle any feathers right here. If anything, he may soften his approach even from what he did a week or 2 ago, when he was saying we're still going to let it be data dependent. But now he may be coming out tomorrow. You may hear them talk about, rather than going 4 and 5 hikes, you may say, well, we're going to do the 2. We'll see what happens there. Then they may talk about with the market pullback, we may see inflation pullback just because people will be a little bit more selective in their spending, and they're going to want to weigh, how this pullback is going to affect the inflation numbers. The supply chains are starting to go. We're starting to see less COVID and Omicron cases in here. That's certainly going to be a plus for the market. But I wouldn't expect to see an overly hawkish Fed tomorrow, to say the least. Now, the risk on there is if after Chairman Powell speaks, you'll often get a lot of these Fed presidents come out and they want to put their 2 cents in, and sometimes they overreach their bounds, and you'll see them be a little bit more hawkish than the chairman. So I don't think you're going to see. I would think you're going to get a relief rally tomorrow, which could go up. I wouldn't expect to see it blast through the 200-day moving average. That probably would be a spot where we'll see resistance, and that would be on the S&P 500 if we get a relief rally tomorrow, we probably see it go up around 44.30, 44.50 would be probably where you'd see the things start to peter out. As far as the NASDAQ goes, as far as the Dow goes, if we get a relief rally tomorrow, you're probably, that could get you up to, I don't think we would see it go up more than about the 34.670 to 34.8. That's gonna get close to the 200-day moving average. So any relief rally that we get tomorrow, I would see it probably peter out ahead of those resistance areas. Once those areas are broken, rather than the support areas, they immediately become resistance for the market, and that's the areas I think we'll see some problems. So besides that, it's not what we look at with the indicators normally, but of course you still have the tensions going on in Ukraine. That's another reason why the gold and silver prices are moving up. That obviously would affect the market, going forward if we saw some bullets fly over there. That's just another reason to be cautious. But as we've talked several times, when we do get these kind of pullbacks, get your stocks that are making good money. Some of your commodity type stocks later on in the phase where you're the economic phase, those actually outperform a little bit. Some of these high flyers like your Microsoft and your Apple, that they're down double digits already. That probably represents a good buying opportunity. But you don't want to just jump in. Like Microsoft broke this 200-day moving average for the first time in like a year or two. That's probably somewhere down here in this 280 area. Is somewhere where if you want to put a buy stop in there and say, okay, if it gets down to 280, I'll buy a half a position. And if you're trying to buy 100 shares or whatever, so you buy some. If it goes a little bit lower, you still have the opportunity to maybe add your position a little bit lower. You haven't blown your wad right here on the at that higher price. So you can start to nibble away here. I do expect a relief rally, which I would not necessarily sell everything into it, but I might, if you have some positions that you're not real happy with, or they're highly speculative or something, maybe you can lighten up or that, or once they jump up, maybe you can you can hedge them by selling some covered calls, or possibly even you buy a call spread where you can bring some money in on those, and then as they go back down, you make the premium on your call spread. But other than that, I think this isn't one where you want to be the hero and jump in and go, boy, I cut the bottom. There's still too many things going on, and negative divergences are still there. And just because the market's oversold or overbought is not a reason to jump in and buy or sell, because it's like I say, when they're overbought more often, stocks become overbought for a reason. It's because they're doing great and everybody wants to own them. In this case, the stocks are oversold for a reason. Is because things are changing right now. The rates are going up. We're having a change in monetary policy, and the reason, and they're oversold again for a reason. And that's not the reason just to jump in. So I would still be extremely cautious in here. I wouldn't be looking to jump in. Nibble on some positions, find some areas on support of the charts that you think, if this falls down to there, I'd like to buy some, and just part of a position goes lower. You can always add to it later on. But let's see what happens over the next couple of days, especially with tomorrow's talk. Again, I would expect to see the relief rally. You don't want to buy into the relief rally by any means. Use that maybe to put in some hedging positions on, and we'll see what happens here in the next couple of days. And I'll be back in Atlanta again next week, so we can go a little bit more on the tech talk and see what transposes over the last couple of days.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer on the next Tuesday Tech Talk, email it into support@marketedge.com, or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.
All righty. I'm going to head over to Poland, and I will be back.